Just days after a bank run on its deposits caused Silicon Valley Bank to become the largest bank failure in the United States since the 2008 financial crisis, the Department of the Treasury, the Federal Reserve, and the FDIC just announced a bailout for Silicon Valley Bank. Well, sort of. Because this isn't the same kind of bank bailout we may remember from 2008. Back then, banks and investment firms were loaded up to the gills in toxic assets in the form of mortgage-backed securities. At the time, no one knew who had the greatest exposure to all these toxic assets and which bank would be the next one to fall. So lending between banks and liquidity in the industry essentially totally dried up. In response to that, the government created Tarp, the Troubled Asset Relief Program, where the U.S. Treasury stepped in and was authorized to purchase up to $700 billion of these essentially worthless assets from the banks. This allowed the big banks to shore up their balance sheets and save the companies from totally collapsing. In response to the 2008 crisis, the Treasury was also authorized to buy up to $250 billion worth of stock in the big banks in order to help supply them with some much needed capital. Now, in the end, when it was all said and done, the government and the taxpayers actually ended up profiting about $31 billion from these programs. But they weren't exactly popular at the time, and most people haven't softened their view on them since. Bailing out banks and big corporations with taxpayer money is just simply not a popular idea with anyone. In any event, every move the government made back in 2008 was designed to help the banks stay afloat and survive as companies. That's why companies like Wells Fargo, Citigroup, and Bank of America are even still around today. But what's happening now with our two most recent bank failures, Silicon Valley Bank and Signature Bank, is that the government is stepping in to protect the people and the businesses that had accounts with these banks, not the banks themselves. Typically, as we know, the FDIC insures up to $250,000 in deposits at a bank. As part of this bailout, the government is now guaranteeing that you'll be able to get all of your money back from these banks, no matter how far over that amount you or your business was. The banks themselves will no longer exist unless another bank steps in and buys whatever remains are left of them, and both stockholders of these companies' shares and bondholders of these companies' debts will see total losses on their investments. And maybe most importantly, the executives at these banks, the ones that actually made these bad strategy decisions that led to the bank's failures, will also all be hitting the unemployment line. Though there's no word on the millions of dollars worth of shares of stock that some executives dumped just days before the bank's collapses yet. And if you missed all the reasons and all the things that actually led up to Silicon Valley Bank collapsing, check out this video where I explained it as simply and clearly as I possibly could. So the depositors are being protected, the executives and all the investors are being hung out to dry. How exactly is this quote-unquote bailout working? And what's going to happen in order to cover the depositors of Silicon Valley Bank is that the FDIC is going to insure all their deposits above and beyond the original $250,000 limit. So every bank that is FDIC insured pays premiums into this, and that's where the money for the FDIC insurance comes from. And the government has also said that an additional fee will be assessed to all FDIC member banks to make up for any losses of the FDIC fund if liquidating the assets from Silicon Valley Bank doesn't cover all the money that's needed. Which by all accounts, everything I have read thus far, the bank's assets should be able to cover all the deposits, and all that's really needed here is temporary liquidity so the depositors can get their money back sooner rather than later. And a lot of people are still angry over this bailout for a number of reasons. First and foremost, because as we learned, the main clientele of Silicon Valley Bank were a lot of venture capitalists and tech startup types, two groups of people who are very easy to dislike. But if we go back to the basics, anyone who deposits money into a bank expects it to be safe. No customer, whether it's an individual or a business, can be expected to continually analyze the balance sheet and strategic decisions of a bank just because they happen to be a customer there. And $250,000 is a rather low insured deposit limit once we get to talking about business accounts. I run the finances for a rather small company as my day job, and I can tell you we need well above $250 liquid in our account at any one time just to cover payrolls and everyday bills and expenses to the company. And you really can't expect any company to have 10 different accounts at 10 different banks and try to juggle funds between them just to stay under this arbitrary deposit insurance limit. So I do think what the government is doing here is the right move. But that doesn't mean that the effects of these bank failures still aren't going to be felt in a number of different ways. Bank stocks are still getting crushed in the stock market as people fear that any number of other banks could be facing the exact same problems that led to Silicon Valley Bank collapsing. I mentioned that The stock shareholders and the bondholders of Silicon Valley Bank would see their investments totally wiped out. Even if you're an index fund holder, you likely had exposure to these companies in the index funds that you hold. Two of the largest holders of Silicon Valley Bank stock by sheer number of shares were the Vanguard Total Stock Market Index Fund and the Vanguard Mid Cap Index Fund. But thankfully, that's why we invest in index funds. So the effects of any one company in the index failing are rather minor to our overall portfolios. And even though the government says the taxpayers won't directly be footing the bill for this bailout, many people are upset at how quickly and how decisively action is being taken to save the money of the wealthy class, who were set out just to lose amounts above and beyond $250,000, when insurance limits of all shapes and sizes screw over regular people every day without so much as a second thought from anyone else. But I guess that's a video for another day. If you're not totally caught up on everything that happened to lead Silicon Valley Bank to collapse, check out this video over here where we go over just that. Thank you for watching this one, and I'll see you next time.